Hey folks, welcome to today's episode of the Hospitable Host podcast. Today we're speaking to Jeff Ball from Visio Lending. We're talking all about DSCR loans and essentially how to finance your next short-term rental. Some key things that you should be looking out for and some consideration in terms of what financing approach could work for you. So if you like today's episode, please don't forget, give us a like, give us a share, give us a rating, and wherever you're listening to the podcast, that's always very much appreciated. Thanks and enjoy the episode. Hey Jeff, thank you so much for joining us today. How are you doing?
I'm doing well, Miles. I'm excited to be with you.
Good. Thank you very much for joining us. Let's get kick-started straight away. Maybe you can introduce yourself, Jeff, to start with, and give us a background on how you ended up at Visio Lending.
So my background, I actually started out as a securities attorney in Silicon Valley back in the mid-90s. And then from there, I went to investment banking, not in real estate. I was actually ran the semiconductor device investment banking business for JP Morgan out of San Francisco. And super interesting. It used some of my legal experiences and my finance background. But then in end of 2006, I decided I wanted to take a different path, and I took some time off. And then towards the beginning of 2007, I started another business that bought and sold bank foreclosures during the financial crisis. And it was really through that process of buying and selling about 12,000 homes across the U.S. that we saw the opportunity that turned into Visio Lending. So the company I run today is a company we started back in 2013 called Visio Lending. That today is one of the leading financiers of single-family rental properties around the country, financing both long-term rentals and short-term rentals, really all over the U.S.
Nice, awesome. And then obviously we're kind of here to talk about DSCR loans specifically.
Yeah.
I'm a bit of a novice myself. I have my own apartment here. I have a regular run-of-the-mill mortgage. It's my primary residence. But how does a DSCR loan differ from that? Maybe you can talk us through some of the basics before we get into the details.
Yeah, it's kind of fun. Now today, people actually understand, or they refer to it as a DSCR loan. We were one of the early pioneers of this back in 2016. After the financial crisis, the financing options for single-family properties in the U.S. narrowed dramatically.
Yeah.
And one of the needs that we saw in the market was for financing of stabilized single-family rental properties. And because we have been working with these small investors all over the country, many of which were focusing on flipping properties, but there was a whole nother cohort of investors that's really large and kind of under people's radar screens that own these single family rental properties. And so really the insight was, could we design a loan product that looked much more like a commercial loan on a residential property? And when I say a commercial loan, it's a loan that focuses very much on the property level cash flow rather than the borrower's individual personal income. And so that's much more the way a commercial loan works. And so in concert with a capital partner out of Southern California that was really a mortgage-backed securities expert, we worked on designing a product that would both meet the needs of bond investors on Wall Street, as well as meet the needs of investors who wanted to, build portfolios of single-family rental properties. So what's unique about a DSCR loan is, as I said, we focus on the property level cash flow. So we match up the rent from the property to the principal, interest, taxes, insurance, association dues. And when we underwrite the loan, we look at the borrower's credit. Again, we look at this DSCR calculation. We look at the loan to value, and we do also look at cash reserves. But we don't ask for people's pay stubs. We don't ask for folks' tax returns. And so for rental properties, and particularly for investors that own a lot of rental properties, it's an incredibly powerful product that allows them to grow their portfolio of properties without it being attached to how much personal income are they generating from kind of a 9-to-5 job.
Yeah, that makes sense. Yeah, I can see how it can be much more attractive for a short-term rental house versus, that traditional homeowner mortgage. To expand on that, to kind of you start to talk about, I guess, the application process a little bit and some of the things that you ask for. What does that look like? When does a short-term rental host go, hey, Visio, I want to get another property kind of thing. I
Yeah.
want to get my first property. And how do they kind of provide some of that evidence?
So my encouragement to listeners would be either if you're in the short-term rental business looking to grow your portfolio, if you're looking to get into it, to reach out to us, or there's other financiers in the market
Hmm.
to learn more about the process. Because a big part of the way we've structured our loan product, we talk about it turning a variable into a constant. When somebody's looking for an investment property, be it a short-term rental, one of the things they want to know is what are the financing terms going to be? How large of a
Yeah.
down payment am I going to have to make? What's the fees and the rates going to look like? And any other terms related to that. So starting that process earlier, I think, is useful so that you have a real good idea as you're kind of working your numbers, what the financing costs are going to look like. So we work predominantly with experienced investors. Our typical investor across everything that we've done owns about 10 properties. That's less with respect to short-term rentals. Short-term rentals is a newer asset class relative to
Yeah.
long-term rentals. So we have a lot of customers. Probably a very common use case for short-term rentals is somebody bought a second home as a vacation home. They started to rent it out part-time and they said, gosh, this works really, really well for me. They're now interested in adding a third or a fourth property. And what they find out is, gosh, my own personal income, I'm going to run out of financing capacity to buy my third and fourth property. And that's where Visio steps in, because our product, again, isn't dependent on their paycheck in order for them to qualify for those subsequent loans.
Of course, yeah. And then in terms of kind of the terms of the loan, is there a massive differentiation between standard mortgage and DSCR? And it's a little different in Canada versus the US. We have 25-year amortization here.
Yeah,
What fun! What about the US? What are some of the common
right.
terms and like down payment requirements for
Yeah.
DSCR?
So everything we finance is on a 30-year term, fully
Okay.
amortizing. We also do offer an interest-only option, but everything amortizes over a full 30-year term. So that's nice. In terms of rates and fees, today they're actually quite comparable to what you would have been able to get on what we refer to as an agency loan. So think of a Fannie Freddie loan, very
Yeah.
similar to what you would use to buy your own home. So that's something that's really changed over the last 2 years. And some of it has to do with the DSCR market has become much larger and therefore liquidity in the secondary market is higher. And so that spread between what we charge and what somebody would obtain from on an agency loan or maybe in the past from a small community bank has shrunk pretty significantly. So, today this is, we're towards the end of September 2024. Interest rates for us are they're probably in the 7% range. And
Mm.
so that's very comparable to what you would see probably on an agency loan. The other things that folks should be aware of, most of what we do in the STR space, but not all, are purchase loans. We also do rate and term and cash out refis. But on purchases and rate and terms, our maximum loan to value is 80%. So that means on a
Okay.
purchase, you're going to have to bring a 20% down payment. It's pretty standard. The other thing about DSCR loans, I'd highlight a couple of other nuances. So the first thing, you can actually finance your properties in a legal entity with us. On an agency loan, you can't do that.
Mm-hmm.
And so that's something we certainly encourage small investors to do, is to hold their properties in an LLC or a corporation, because it's just we think it's just good risk management. And so that's something that a DSCR loan offers. Our reserve requirements are more lenient than what you would typically encounter on an agency loan. So we typically require 6 months of principal, interest, taxes, and insurance. But most importantly, our reserve requirements are not cumulative. We require reserves on the properties you're financing with us at the time, rather than
Okay.
accumulating reserves across all of the properties that you have financed. And so, yeah, that's, and then I guess the last thing I would highlight that's maybe a little bit different, because this is a commercial loan on a residential property. In our space, prepayment penalties are very commonplace. And so for listeners, if they're not familiar with what a prepayment penalty is, It basically says if you pay the loan off early, and it's typically prepayment penalties range anywhere from 1 year to 5 year.
Yeah.
If you pay the loan off early in that time period, you're going to pay a fee at the time that the loan is paid off. That's really designed because it's expensive to originate these loans. And so
Yeah.
if somebody like us originates a loan and the borrower pays it off 6 months later, we don't recoup the cost of actually originating the loan.
Yeah, that makes a lot of sense. Cool. That's, I think, a good thing to caveat out there. So very briefly, at one point you kind of mentioned your interest rates, and the Fed, I think, finally made the decision to drop rates. I think that's September 18th. They dropped the base rate. Potentially there's more to come. We can't predict what they're going to do, obviously. How has the increase in rates kind of affected what you've seen in the market? Has there been a slowdown in DSCR loans? And I guess, are you expecting there to be a bit of a change now off the back of potential further rate drops from the Fed?
Right. So, we're a couple of years into, elevated mortgage rates.
Yeah.
And interestingly, we came into this year, the futures market, the Treasury futures market, which is really what drives mortgage rates rather than the Fed. The Treasury market at the beginning of the year was really anticipating that the Fed would start reducing rates earlier this year than they have. And so we came into this year expecting that volumes might be muted just because folks were going to sit on the sidelines waiting for lower interest rates. It's actually we've seen a very significant uptick in activity this year. And I think that's true of ourselves and our peers. I don't think it's unique to us. And I think there's a couple of things that's been going on in the DSCR space. Earlier I alluded to the fact that the spread between a DSCR loan and an agency loan is much smaller. So today, I think a lot of folks who own single-family rental properties, whether again it's a short-term rental or a long-term rental, they've come to realize that a DSCR loan is easier to apply for, more flexible than an agency loan. So I think DSCR loans are being used as a substitute there. I think the other side of it is in the past, folks could obtain, depending on their financial wherewithal, they could obtain loans from small regional banks. And small regional banks are not in the business of financing single family rental properties for investors right now because of all of their issues with exposure to commercial real estate. So we've actually seen strong demand this year, stronger than we anticipated coming into the year. So now as we look at if we're in a declining rate cycle and as the Federal Reserve starts to lower rates, some of it's going to depend on how quickly they do so. Obviously, there was a lot of back and forth as to was it going to be at 25 basis points or 50 basis points. They chose to do 50. Mortgage rates have actually been trickling back up after the Fed action as the bond market and the futures market readjusts to thinking about what future changes are going to look like. So, my personal opinion, and none of us can accurately forecast this, but I think the Fed will take pretty measured action in terms of reducing rates. And so I think, we'll continue to see some relief in mortgage rates over the course of the next 12 to 18 months. But I don't think it's going to be anything dramatic absent some sort of exogenous event that would cause the Fed to have to take much more drastic action. So for me, I think what that means is we will see more demand in the market for homes. And I think we'll start to see some markets that maybe have seen very low transaction volume in the real estate market to pick up some. We'll see greater price discovery as more transactions, in fact, take place. Because I think a lot of folks have been sitting on the sidelines thinking interest rates are too high. And now they're almost 200 basis points off their high. So I think psychologically people are adjusting to rates in the high fives, low sixes look really good relative to where they were 6 months ago.
Yeah, that makes sense. And you said that you're already kind of seeing a decent demand this year. In the short-term rental space, have you seen any trends in particular markets that seem to be picking up quicker than others?
So I would say, and it's interesting, Standard & Poor's, which is one of the big rating agencies that rate all the bond markets, bond deals, just released a research piece about using debt service covered loans, DSCR loans, for STRs. No surprise, the big markets are in Florida, Tennessee.
Yeah.
So, those are the markets where we've seen kind of the greatest activity for ourselves. We have the greatest presence kind of east of the Rockies. We do finance in California and Arizona, but it's not as large of a part of what we do. So certainly Florida, Tennessee. We see a fair amount up on the eastern seaboard in Jersey, the Jersey Shore, and we see a fair amount of demand in Colorado around ski towns. And we also see a fair amount of demand on the Texas coast, which is quite interesting. So
interesting. Yeah. So, some key markets there. I'm sure we have plenty of listeners
right.
in those markets.
Yeah.
Yeah. Or
No
at least
surprises.
even if they're not based there, yeah, their properties are based there. For sure.
Right.
Cool. So I'd love to kind of, we're kind of getting towards the end, but I'd love to kind of get your, quick take on, we've talked about a lot of things, but if, I'm new in the short-term rental space and I'm considering a DSCR loan, what are some of the key things that I need to be thinking about? What are some key tips that I should take away from this? Whether I'm approaching Visio or someone else, what are the key things that I should consider before I make that step?
So, I think I'll mention some of the more nuanced things because I've already talked about kind of the high level requirements. I think the nuanced things would be anytime a property is unique, whether it's in location or size, format, that is going to just present nuances that'll be taken into account in underwriting the property. Any DSCR lender is going to look at the loan and they're asking the question of, can the property generate sufficient cash flow consistently over the, averaged out over the course of the year to make the monthly payments? But they're also asking the question of if this property needed to be resold to, most likely, given the markets, to a vacationer, would a vacationer buy that as a second home? So I would just say if the property is unique in terms of a remote location or it's very unique for the properties around it, and or if it's been converted, we see large format properties with lots of additional bedrooms and bathrooms. Those are the types of properties that are going to probably just introduce more financing complexity and risk. And so definitely for folks who are getting involved the first time, just be thoughtful about that. It introduces execution risk and getting the transaction done. So we see a lot of those. And I would say for investors who are more experienced, who have demonstrated execution on multiple short-term rental properties, that influences how we think about it. If it's somebody who's getting into short-term rentals for the first time, our strong preference would be, hey, pick a property that's a bit more, fungible in a more fungible market with a kind of a proven approach and track record, would be our preference. The other things I would point people to, I mentioned the fact, we very much prefer folks to finance in legal entities. We think that's good from a risk management perspective. The other thing that's, unique to both long-term rentals and short-term rentals, but the type of insurance that you use for these properties is not the same as your homeowner's insurance. So getting in front of that issue, both in terms of having the appropriate casualty and property insurance for the property, and then also thinking about any sort of incremental liability insurance that you want. That's also, I think, important. So I think those would be some of the more nuanced points that I would emphasize for folks.
Yeah, that's fair. That's good to know. And I think there's some good key tips in there for you to find your property in the first place before even thinking about financing, is thinking about, is it something that's definitely going to generate revenue, right? And that's exactly what folks like you, the lender, is looking at. So
that's right.
It's a good acid test, I guess, in a sense. Cool.
Yeah.
Awesome. Thank you very much, Jeff. So I think we're going to end it there. I think just the final question for you is, if folks are interested in learning more about Visio lending and potentially getting some financing, where can they go to find that information?
Yeah, so the best place is our website. It's visiolending.com. So VISIO lending.com. We have a lot of content on our website about how our product works and how it supports short-term rentals. And then also clear ways to get in touch with our sales force. SCRs are about a third of what we finance. And so we've done about $1 billion of these. So we've done thousands and thousands of short-term rentals. And so, we have good experience about how to get these loans done and how to get them done efficiently. So we'd love to help your customers out with their financing needs.
Sweet. Thank you very much, Jeff.
Miles, thanks for having me.
Cheers. That's all for today's episode, folks. I hope you enjoyed it. As always, please give us a like, a share, and a rating wherever you're listening to the podcast. Hopefully you can give us 5 stars. That's obviously very much appreciated. And stay tuned for our next episode coming very soon.